All right. So, yeah, no, thank you guys so much for joining. As Taylor said, my name is Daniel Carnes. I'm an investment analyst and financial advisor here at El Dorado Financial. Just a little bit about myself and my experience. Before teaming up with El Dorado, I used to be on the advanced trading desk at Charles Schwab. I was dealing with all the, crazy options and margins traders and the day traders and all that. So I got a pretty interesting experience there, but really good nonetheless. My wife and I were, given the opportunity to move to Montrose and, Western Colorado, quality of life, and, haven't looked back ever since. So, like I said, originally from Phoenix, Arizona. But yeah, just been loving Colorado so far, and can't wait to see what the next forever brings. So real quick before we jump right in, this is just a little disclosure. This is for educational purposes only. Please conduct your own due diligence before making an investment decision or your own research. Consult with a registered financial advisor. In other words, in very simple terms, please, 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 please do not sue me. So kind of going on into today, or tonight, I should say, we're just going to go over some basic stuff, some good budgeting and good money habits, especially nowadays during times of COVID. We'll go over some holiday gift planning, some tips and tricks there. We'll talk a little bit about debt management, and then we'll get to the big subject, which is kind of this 2020 market and economic update. So that's kind of where I get a twinkle in my eye and all excited. So it'll be very interesting. I have to give my wife a lot of credit for this slide. She was the one that found this picture, and I'm pretty sure it perfectly explains what 2020 has been all about. Just would not recommend it. So I'm pretty sure a lot of people really excited for the year to end and kind of going into 2021. Um, Kind of in the start of COVID, leading up to today, what I started to do is start kind of digging in for this presentation, just some interesting information. And the real big question I wanted to ask is, how has COVID-19 or living in a post-COVID world affect people or affect the way people manage their money? So according to our friends at the Bureau of Economic Analysis, what I found very interesting was that for the last several years, the average savings rate in America was somewhere around maybe 6 to 7%. Since the start of COVID and since 2020, as you can see on this graph right here, it just completely spiked. So, upwards almost 34%. And then kind of moving forward, one thing that also came out from the Federal Reserve Bank of New York, household debt went down for the first time since 2014. So kind of the economic pressures, being, COVID being the catalyst has definitely affected the way people manage their money. So kind of the big goal of this really is to just kind of solidify, hey, this is why we budget. This is why we have an emergency fund. Um, you know, yeah, they're really basic, finance skills that I believe everyone should learn. But I think having gone through really tough times, like a lot of people are going through right now, I think these skill sets are way more relevant nowadays than they ever were. So to kind of start off with budgeting, really the question we have to ask is, why do we budget? And the one thing that you'll notice if you start making a budget is you'll find yourself in a whole lot less financial stress. Sometimes I just have to tell people as an advisor when they'll come into our office and we'll chat and they'll talk about their finances a little bit, and they talk about, hey, I'm having a hard time with this and that. And, oftentimes I have to tell people to grow up. And sometimes I have to tell, we got to put on our big boy and big girl pants on. And, we have to actually sit down and, take something like 10 minutes, write out what's our income and what's our expenses and do really basic math and figure out what the end result is. I'll just tell you this right now, budgeting nowadays, as boring as it sounds, it is way easier than it has ever been. You think budgeting, you think like a piece of paper, a pen, you're writing it down and all that. There's apps out there, Mint and Every Dollar being the two big ones that come to mind. I'll tell you this right now, my wife absolutely loves Mint. I mean, it's so easy. You download the app. It does a lot of things for you. You can link up all your bank accounts and your 401ks and your investment accounts. You can link up like your mortgage and, what, your car loan, your, whatever debt you have. And it basically gives you a picture of, what your net worth is. And then what's really cool about this is that it helps you budget and helps you set certain parameters. Like, okay, we're going to spend X number of dollars for groceries. We're going to spend Y number of dollars for entertainment. And what's cool about it is that it will track what your spending habits are. So that way, let's say at the end of the month, you look at it, it's like, ooh, we kind of went overboard on the entertainment. So let's kind of dial that back a little bit. So every dollar app, Mint especially, I would take full advantage of that. The other thing I found out recently too was a lot of the bigger banks, like I think here in Montrose, Wells Fargo is really one of the few big ones that we have. USAA, Chase, Bank of America. Basically, their apps, those apps for those big banks will have some kind of budgeting feature on there. So that's something you might want to take advantage of. So kind of moving on, I mentioned a little bit about having an emergency fund. And funny enough, I think I was talking to Taylor a few months ago, kind of in preparation for tonight. And she was telling me about how, she was having some car problems, or, something happened to her car and it was just all out of whack. And, one of the things that she found out, and what a lot of people find out by having an emergency fund, is, it takes a major financial setback and turns it into a minor inconvenience. So if my air conditioner goes out tomorrow or the car breaks down, okay, that really sucks, but hey, we have something, we have some extra cash here that we can utilize to get us through those hard times. And, with COVID and with, people being sequestered to their homes and not being able to work, it was a very big reason. This is why we have an emergency fund. Even nowadays when I meet with clients, or if we get new clients coming in, my first number one question I have is, hey, do you have 3 to 6 months of emergency cash in your bank account or somewhere? So, and that's kind of the general rule with an emergency fund. You want about 3 to 6 months. The other thing that I'll also mention too, and the reasons why we have, the reason why we have the picture of the can of tomatoes or the chicken noodle soup and the safe, when COVID happened, I'm totally lost. Where did I go? Okay, sorry. So when COVID happened, there was a short period of time where the banks were closed, and having some cash in your home somewhere safe, in like a little can of, it's a little makeshift can of chicken noodle soup that you can hide in the pantry, or you can get a fireproof safe, having some cash on hand. So that way, if we do go through a lockdown again, that cash is designed to basically get you by until the banks reopen. So if you can have a good amount of cash that lasts you about a good solid 30 days or so, until the banks open back up, you should be good to go. So general rule, about 1 to 2 months of expenses. And then the other thing that we need to talk about is just, 401ks, IRAs. If you work for, a library or a school or a hospital, 403b plans. I'll talk about the stock market here in a little bit, but if there was ever a time to be putting money away for retirement, especially when you have those dips in the market, these are kind of the times, especially, probably not now, but when we went through COVID, I'll talk a little bit about that later, but man, it's just save now, save early, utilize those resources to you, your 401ks, get an IRA opened up, 403bs and all that. And then as far as investing is concerned, we recommend mutual funds and exchange traded funds. In very simple terms, a mutual fund is, instead of picking an individual stock, you actually have a whole basket of stocks that you're invested in. It's a really good cost efficient way to take, pool your money and other investors' money and bring it together to get that kind of diversification and exposure. ETFs are basically the same as mutual funds. They just trade like a stock. So they're becoming more and more popular. So I mentioned that I came from Charles Schwab, and I, was on the advanced trading desk. The big reason why we recommend diversified investments like mutual funds and exchange traded funds is that, in my professional opinion, there's absolutely no reason why anyone should be picking individual stocks. So kind of give you a kind of a visual. There's this guy who is a fund manager for T. Rowe Price. His name is Larry Puglia. He's been doing his job for probably 27, 30 years, as long as I've been alive, if that helps date myself. But, you know, if basically me picking individual stocks on my own is basically me saying that I'm smarter than guys like Larry Puglia and the thousands of other stock analysts for these big giant mutual fund companies. You know, it's kind of like the idea of, you know, me jumping into the octagon against Conor McGregor. I ain't coming out of that alive. Yeah, I'm just being honest. So when I invest in mutual funds and exchange traded funds, those guys are actually fighting for me. So, you know, it just basically, instead of having me fight against Conor McGregor, he's actually fighting for me. And then we, you know, try to invest our money and get it to grow and all that. So that's the big reason why we don't recommend individual stocks a lot. You know, and also I'll kind of mention this too. One of the advisors here, Jim Elder, he's been doing, you know, he's been investing since the 70s, and he'll tell you, you know, what his first stock he ever bought. Back in those days, you know, you could get away with picking individual stocks because the speed of information was a lot slower than it is now. I mean, you're talking about algorithms and supercomputers, and just, you know, the moment you see an article about a company like Amazon or Walmart, it's already too late. You know, there's already been some movement or correction or whatever on that particular company stock. So that's kind of the big reasons why we don't recommend individual stocks.
Excuse me, Daniel. I think we
Yeah.
have a question in the chat.
Oh, okay. Let me get the chat. Sorry. Where is the chat? Where is the chat? Here we go. Cool. All righty. Cool. Okay. Let me see. I think the question is, any ideas on how I can get an emergency fund started when it's hard enough to just pay the bills? So as far as getting an emergency fund started, if you're talking, you know, trying to keep your head above water, let me actually just get, so wait, any ideas how to get an emergency fund started when it's hard enough just to pay the bills? So, you know, budgeting is going to be key. Lining up your income with your expenses, cutting out whatever you don't need. You know, if you can live without Netflix, if you can live without Hulu, if you can live without those magazine subscriptions, figure out exactly what it is you can live without. And that's kind of going back to what I mentioned earlier. It's, you know, we really have to put our big boy and big girl pants on and figure out, okay, what can we, you know, what is it that we actually need versus what we actually want? So really just kind of taking your budget and looking at it objectively and saying, okay, look, you know, we're just getting by the skin of our teeth. We need to cut back on some stuff. And so that's where tools like Mint and Every Dollar app come into play. And then kind of, and so let me see. Do you suggest paying off debt before create an emergency fund? So so a very basic thing that you can do, and that's actually a really good question. You can basically, the good first step is just save up $1,000. So if you can get $1,000, then that kind of leads into my next talking point. Actually, hold on. We'll get back to the debt in a second. So before continuing on, so kind of coming out of investing, we got our, you know, we have this holiday gift planner. You should also get this handout by Taylor sometime soon. One neat trick about holiday gift planning is instead of having all those gifts bought in like November or December, putting more strain on your budget, space them out through the rest of the year. So, you know, and you don't even have to use this for just Christmas. You can use it for birthdays. You can use it for anniversaries. You know, it's just really simple way of just saying, you know what, I'm going to go ahead and buy my mom's Christmas present in January, and then buy my dad's in February, buy my brother's in, you know, March, and so on and so forth. So that's a really neat trick there. And then kind of going to the questions that are at bay, about debt management. Really, it's not as complicated as what a lot of people say it is. One easy little thing that people can do is, basically, if you're a Dave Ramsey fan, you can follow the debt snowball. You just list out your debts from smallest to largest. And then you go from, you take whatever extra income you have at the end of the month or at the end of the week or your pay period, and you chuck at it at your smallest debt. So, you pay off your credit card, and then you work up to your, your car loan, and then you work up to your, the student loans and the mortgage and so on and so forth. So it doesn't need to be complicated. And just kind of going back to the question about the emergency fund, it's good to have a good $1,000 in the bank just in case, and then focus on, kind of that debt eliminator, trying to get the smallest debts paid first, and then work your way up the chain. And then after you have that debt taken care of, other than the mortgage, then you can really start going, that just opens up your budget a lot more, to build up that emergency fund, that 3 to 6 months, and, factor in how much cash you want to have on hand just in case. So kind of, easy peasy going from there. And, I love this comic. It's just, takes the debt snowball. Again, nothing needs to be complicated. We just need to just, in our experience, for our clients, we recommend the snowball effect, just because it's a really easy way to get people motivated to pay off their debt. It's like, okay, I paid off my credit card. Ooh, that's really cool. Now I get to pay off my car loan. Okay, now it's my student loans, and so on and so forth. So it's really cool. Nice little tidbit for those of us that are proud owners of a mortgage. You can cut the time in half that it takes to pay off your mortgage by adding anywhere around $600 to $700 on top. $600 to $700 on top of your mortgage payment, I should say. So you have a 30-year mortgage, you add another $700 on top of the actual mortgage payment, you'll have it paid off for roughly 15 years. All righty. And then I think, Taylor said that she should have emailed the debt eliminator as well as the holiday gift planner. So there is that. Now we get to the really fun stuff. So I talked a little bit about investing in the stock market, the mutual funds, the ETFs, and with COVID, it kind of created a lot of fear, a lot of uncertainty. And to kind of really understand where we're at now, we kind of have to look at, I think there's a question, $700 a year, $700 a month, Chris. So every single month you have a mortgage payment, add another $700 to that every single month. So that extra $700 on top of your mortgage payment every single month, that's going to cut the time in half to pay off your mortgage. So there's that. Good question. Sorry. All right. So kind of moving forward into the market update. So to kind of understand where we're at right now, we kind of need to understand where we came from. In 2019, we were doing pretty darn well for ourselves. I mean, we had, the lowest unemployment that we have ever seen, at as low as 3.5%. I mean, you talk to economists 30, 40 years ago, they would have told you we've never would have gone below 6%. But lo and behold, we got as low as, 3.5%. We had low inflation based on the consumer price index. We had positive GDP. GDP is just a standard measurement of economic growth. So that was all positive coming from 2019 and going into 2020. We had household incomes were up, building permits and housing construction was up. And, as you can see, the top left-hand chart, the S&P 500 went up over 30% in 2019, which is pretty high considering that the average for the last 10, 15 years is about 10% on average. Here we go. Cool. So then kind of going into 2020, we were doing really well for ourselves. And really the only thing we were expecting volatility wise in the stock market was the election. Usually election years will have more than average volatility in the stock market. That's just primarily because of the uncertainty. It was about late January, we heard about this whole COVID thing. And the way that I like to explain it to clients is it was the boy who cried wolf. Well, why would I say that? Well, basically, from a perspective of a financial advisor, when a virus gets the main headline on the big news outlets, so let's just think of SARS, for example, if you remember the early 2000s. SARS would get all the media coverage and then created a little bit of uncertainty, a little bit more volatility in the markets. If I remember correctly, the S&P 500 went down about 12% during SARS. So there'd be a little bit more volatility, and then it just kind of fizzled away and everyone went on our merry way and everything was okay. So when we heard about this COVID thing, it was like, okay, like another virus. And to kind of help put this whole thing in perspective, according to the CDC, okay, since the year 2000, we have dealt with SARS, we've dealt with mumps, we've dealt with E. coli, bird flu, swine flu, MERS, Ebola, Zika, and now COVID-19. So it was like, okay, another virus, news headlines, volatility. We've been through this whole rigmarole before. And really, from an economic stance, the big concern that we had with this whole COVID thing was, there would be a little bit of disruption in supply chains with businesses around the globe, because, think about companies like Apple and Nike that have manufacturing in China. And then the craziest thing happened. We went through a complete, utter, full-blown foot on the brake, shut down, lockdown within the economy. We have never seen anything like this before. It was just so crazy. I mean, in a very short amount of time, unemployment, remember 3.5%, that's the lowest we've ever been through, or lowest unemployment we've had ever. It spiked up over about a little bit over 14% into the double digits. Second quarter GDP took a really big hit, being down negative 33%. And then our good friend, the S&P 500, dropped 35%. Now, I kind of want to put this whole thing in perspective again. During 2008, during the mortgage crisis, the S&P 500 fell about 55% over a span of 17 months. Just think about that for a second. 55%, 17 months, a little over a year. The S&P 500 between February and March dropped 35%, almost 2/3 in 2008 in 24 trading days. This was not normal. This wasn't an actual financial crisis like we had in 2008. This was like an absolute economic shutdown. So then really, is that the end of the story? No. Crazy enough. Yeah. So what ended up happening was we went through the really sharp decline. And then from the March 23rd bottom, the S&P 500 went up over about 60% just within this year alone. And basically what was happening, and my main hypothesis, I don't have a lot of data to back this up, but still my main hypothesis with this is after we had the shutdowns and, people were being laid off and furloughed, the stock market took a massive hit. We had all these, economic and, analysts like Muhammad Al-Rin, for example, was saying, oh, it's going to get retested. It's going to go down again. There's, the Federal Reserve is going to have to do a bunch of stimulus and, this and that. Well, then with all these people at home, it's like, well, I still got to pay my rent. I still got to buy groceries. So why don't I just get in the stock market and, at least try to make some money? Well, then the retail investors came in and started propping up the markets. And then it just kept going up and going up and going up and going up. And then basically all the so the retail investors came in, propped everything up. And then slowly the institutional started to come in. So kind of, as the picture suggests, there's two big takeaways that we really have to understand. No one can really predict the future. And this is why we do not sell. I think there was a question. What are the retail investors? So retail investors are basically the difference between institutional investors and retail investors, the difference between the two are, retail investors are kind of the mom and pops that open up an account and they, buy their own stuff and they make their own trades and stuff like that. Institutional is going to be more financial advisors, big name money managers, your Ray Dalios, your Warren Buffetts, your, pension funds, your 401ks and stuff like that. So those are the big difference between the two. So we had that nice bottom in March 23rd, and unfortunately, me and the other advisors here in the office, we had two clients that sold at the very bottom, and we tried to talk them out of it. We tried to figure out, it's like, hey, this is not the time to sell. We cannot panic about this, kind of like as the slide says. And they just couldn't handle the volatility. And unfortunately, they sold out. And again, unfortunately, they missed out on a 60%, incline. So all those gains, they totally missed out on. And again, this is not the time to sell, when you go through a lot of volatility, a lot of fear, and a lot of uncertainty. I'll kind of borrow a funny saying. Art Laffer is I think he was an economic advisor during Ronald Reagan's time, and he has this funny quote. He says, no one in the history of has ever made a good decision when they are drunk or when they are in a panic. So this is basically the little homage to that. Let me get back here. Okay. So, kind of where we're at in the economy, it got a little bit better. The S&P 500 year to date is up about 13%. Unemployment, remember we started at 3.5, went up to 14. Over the last several months, it started to come down. So right now we're sitting somewhere around 7%. It's gotten a lot better. We're not fully there yet, I don't think. I mentioned GDP, that measure of economic growth. Third quarter GDP was up. We had a big boom, up 34%. A few months ago, we went to Denver. We flew to Denver actually, and we, saw some clients that we were supposed to see back in spring, and people were starting to travel around more. That probably will start getting dampened because COVID numbers are going back up again, supposedly. We'll still have to wait to see what the fourth quarter numbers bring. But again, like I said, with the rising COVID numbers, we may see some more volatility, some more issues from that. Before moving on, I'll say that the main concern we have, kind of where we're at right now, we had the nice shutdown, we had the nice little drop, and now we're kind of working our way up. The big concern that we have is that the stock market's up here, the economy is still relatively low when they usually are in sync with one another. The main concern that we have here at El Dorado is that when there is that disconnect, generally speaking, there's supposed to be some kind of correction. When that will happen, how will that happen, what the catalyst is going to be, we don't know. But that's kind of our big main concern right now, is just that big disconnect between the economy and the markets. And then, we could have another, especially with COVID cases and the idea of lockdowns coming around the corner, possibly, we could go through COVID round 2. Another big concern that, a lot of our older clients have had is just the crazy low interest rates. Back in September of this year, Jerome Powell, who's the chairman of the Federal Reserve, he announced that they're expecting to keep the interest rates pegged to zero for the next 2 to 3 years, which creates a problem for a lot of seniors that have a lot of their income and their retirement based on interest rates. So one of the things that we've been doing is trying to find those alternatives that can get them at least a higher yield without taking on too much risk. During COVID, funny enough, I even called a lot of the local regional banks around Montrose, and I just said, hey, give me a quote for a 1-year CD. What are those yielding right now? And a lot of them was like, 0.1%, the highest I was able to find was like 0.5% for a 1-year CD. And that was like back in March of this year. So with the CDs and the money market funds really not paying a lot of high interest rate, or, not paying interest at all. One of the things that we've done is we've figured out some ways to, like I mentioned earlier, try to get our clients into something that is paying at least a little bit higher interest, but without taking on a lot of risk. And that has to primarily deal with high quality treasury bonds and high quality corporate bonds. And, we try to keep the duration or the amount of time it takes for those bonds to mature very short. So that's basically been our objective there. And even since, COVID and, for the investments that we've been, recommending to our clients, we really try to cut down on volatility. The mindset really is, if we had to go through COVID, round two, what would we want to be invested in? What, how, between interest rates, between the risk, between the idea of the S&P going down 35% again, what can we do to kind of reduce that risk, reduce that volatility? So one last thing. So it's going to sound a little bit corny. It is that time of year again. And, I really wanted to give you guys probably the best financial advice that's out there. And that's generosity. And there is a high correlation between success and generosity. Whether you believe in karma or what goes around comes around or reap what you sow, there is something to be said about giving back. I grew up in a Christian home, and one of the things that we believe in is this, is the commandment of tithing. It's, taking a tenth of your income and giving it back to the church. My wife and I, we give to other organizations as well. But I would really highly encourage and challenge a lot of you, take some time, figure out your budget, make sure you're good, and then see about giving back in some way. And, give it some time and, just let me know, how did it work out for you? And I just encourage you to, make it a regular practice and, keep it one of those things that keeps, the gift that keeps on giving. So that's basically it for me. Here's our information. If you ever have any questions, anything you want to talk about, there's our phone number. There's our email address, info@eldoradofinancial.com. We're open from 9 to 4:30 Monday through Friday, and then phone number 970-249-9900. And that is basically it.